They insisted this could never happen. They claimed $75 was the final boundary. They believed the banks would hold that level with absolute control. But today, on Boxing Day, the market delivered its own answer. That boundary no longer exists. Look at your screen. Silver is trading around $75.60s. This wasn't a lucky tap. This wasn't a brief test. This was a decisive break, confirmed by a weekly close at the very top of the range. For 3 years, $75 was where rallies stalled, where confidence was drained, where short positions piled up to suffocate momentum. But today, that mechanism failed. Sellers were overwhelmed by buying pressure that refused to slow down. Not driven by emotion, not triggered by headlines, driven by numbers that no longer worked in their favor. To understand how serious this move really is, you have to look at the timing. Today is Friday, December 26th. Most of the world is on holiday. Trading desks in London and New York are running on skeleton crews. Liquidity is thin, very thin. Normally, this is when they take advantage. Low-volume weeks are designed to work in their favor. They lean on the market, they push prices lower, they paint the charts red and drain confidence before the new year. Ghost Week is usually their playground, but this time, the script flipped. Instead of a smashdown, we got a melt-up. Why? Because the physical demand didn't go on vacation. Industrial buyers in Asia were still active. Sovereign wealth funds were still bidding. And experienced retail investors saw thin liquidity not as danger, but as an opening. They understood something crucial. With senior risk managers away and desks understaffed, the door wasn't guarded. So they didn't knock, they kicked it in. The move to 75.60 produced a massive weekly candle. And this detail matters more than most people realize. We didn't fade into the close. We didn't pull back. We closed the week at the absolute highs. In technical analysis, this is one of the most bullish signals that exists. It tells us buyers were willing to hold through weekend risk. They weren't afraid of bad news. They weren't afraid of headlines. They were afraid of being left behind. That shift, from fear of loss to fear of exclusion, is how trends are born. Now let's talk about the level itself. Why was $75 so difficult to break? Not because of emotion, not because of headlines, because of the options market. Sitting at the $75 strike was a massive concentration of call options, representing millions of ounces of silver. The sellers of those options, the same institutions that dominate the market, were betting that price would never cross that line. As long as silver stayed at $74, they were safe, contained, in control. But the moment price pushed through $75, everything changed. When an option moves in the money, the seller inherits a problem. They now have exposure they didn't want. To protect themselves, their systems are forced to act. Not emotionally, not strategically, automatically. The algorithms step into the futures market and start buying contracts to hedge risk. This process is called delta hedging. And here's where it becomes dangerous. Price moves to 75 doesn't tellers. The system buys futures. That buying pushes price to $75, $30, which forces the system to buy more. This is the feedback loop. This is the gamma squeeze. It's not a rally fueled by optimism. It's a rally powered by math turning against its creators. The reason silver surged to $75.60 so quickly wasn't excitement. It was machines chasing risk they could no longer escape. And because it was Boxing Day, with thin liquidity and few sellers, there was nobody willing to absorb that demand. So price didn't climb, it jumped. The very players who spent years suppressing price were suddenly forced to fuel the move they tried to prevent. They wanted to sell. Instead, they became buyers at the worst possible moment. Now put yourself on the other side of this trade. Imagine being short silver heading into this Friday evening. You sold at $72. Now price is sitting near $75, $60. That's a $3.60 loss per ounce on a leveraged position with the market closed for 48 hours. There's no exit button, no hedge, no control, just time. All weekend, they're forced to sit with one question on repeat. What happens when Asia opens? They have to wonder if Shanghai gaps higher. They have to wonder if silver opens at 77 SOS or $80. They have to wonder if a geopolitical headline hits while they're powerless to respond. This isn't financial stress, it's psychological pressure. When markets reopen on Sunday night, trapped shorts all share one priority: survival. They don't care about price targets, they don't care about valuation, they just want out. And that creates something extremely important: a natural floor under the market. Every dip becomes an exit ramp for a desperate seller. Every pullback attracts forced buying. This is why bull markets feel so resilient. Short covering becomes a built-in safety net. Now zoom out. This isn't happening in isolation. Globally, silver has already been trading higher. We've discussed the Shanghai premium before. While New York was stuck near $72, Asia was already flirting with $80. That gap wasn't sustainable. Metal was flowing east too quickly. Inventory was draining. So the Western market had to respond. This move wasn't excess, it was catch up. Even now, with silver near 75 to 60, there's still a gap. Shanghai remains higher. That difference acts like a vacuum. As long as the US price is cheaper, demand will continue pulling it upward. So don't look at 75 or 60 and think overbought. Relative to the physical market, it's still discounted. Now let's address the fear. Some of you are looking at this chart and feeling it. That tightness in your chest. That voice saying, "This has gone too far too fast." You see a vertical green move and assume it must collapse. That reaction is natural, but in a major breakout, it's also wrong. Markets that escape multi-year compression zones don't move politely. They don't stair-step, they reprice. In these moments, traditional signals stop working. RSI stays elevated. Price stays above moving averages. Pullbacks become shallow, if they happen at all. Trying to short this because it looks high is like stepping onto train tracks because the train is moving fast. Yes, it's fast. That's the warning, not the invitation. This move through $75 is doing something even more important. It's changing psychology. At $60, retail investors were doubtful. At $70, they were cautious. At 75 they're curious. And at $80, they become greedy. This is the transition from the wall of worry to FOMO, and history is clear on this part. The biggest gains in any bull market don't happen when everyone agrees. They happen when disbelief turns into urgency, but discipline still matters. Technical analysis tells us that broken resistance often gets retested. The ceiling becomes the floor. So as we move into next week, don't be surprised by a pullback, a dip to $75, maybe even $74, $80. This isn't weakness, it's the market checking its foundation. If price pulls back to that zone and holds, it confirms the breakout. It tells us the old resistance is gone for good. That kind of retest doesn't end rallies. It launches the next leg. So if you see red candles early next week, don't panic. Watch the level, not the emotion. As long as price holds above the breakout zone, the trend remains intact. And make no mistake, they will try to shake you out. They want shares. They want metal. They want relief from their short positions. Don't give it to them. Now let's talk about psychology, because this breakout didn't just change the chart, it changed behavior. At $60, most people ignored silver. At $70, they doubted it. At 75, something shifted. They stopped dismissing it and started watching it. This is how every major move begins, not with confidence, but with curiosity. Vertical charts make people uncomfortable. They assume something must be wrong. They wait for a crash that feels logical. But breakouts from multi-year compression don't move logically. They reprice. Old signals stop working, RSI stays elevated, moving averages lag behind. Calling this overbought misses the point. Overbought is a condition. Breakouts are a regime change. And here's the key transition. At these levels, the fear of losing money starts to lose against a new fear. The fear of missing the move. That's FOMO. Not the manic kind yet, but the early stage. And early FOMO is dangerous because it brings in buyers who don't wait for perfect pullbacks. That's why dips get smaller. That's why recoveries get faster. This isn't the end of the move, it's the psychological handoff. From disbelief to attention to urgency. Now, let's talk about the calendar, because timing matters, especially for institutions. We're in the final stretch of the year. Books are closing, statements are being printed, and that creates pressure. If silver finishes the year above $75, it forces a decision. Fund managers can't ignore it anymore. They don't get another quarter to wait, they get days. This isn't about conviction, it's about optics. Nobody wants to explain why they missed one of the strongest breakouts on the board. So, what do? They buy, not because it's cheap, but because it needs to be on the balance sheet. This is window dressing. It creates demand that has nothing to do with fundamentals, but everything to do with career risk. And that demand doesn't stop on December 31st. January resets the system. New capital, fresh mandates, clean slates. Breakouts that survive year-end don't fade in January. They get chased. That's why the first weeks of the year matter so much. If silver holds these levels into January, institutional buying doesn't slow, it accelerates. While the paper price hovers near $75, the physical market is telling a different story. Inventory is thin, replacement supply is slow, and dealers know it. That's why premiums are rising instead of falling. Selling metal right now carries risk. If price gap's higher, today's sale becomes tomorrow's loss. So spreads widen. Spot might say $75, but real metal trades much higher. That gap matters. It means the quoted price is lagging reality. The thermometer says one thing. The room feels very different. This is also where miners enter the picture. At these prices, production margins explode. Costs haven't changed. Revenue has. Yet mining stocks haven't fully repriced. That's the disconnect. Metal moves first. Equities follow later. When earnings catch up to price, the math becomes obvious. And markets don't ignore math for long. Now widen the lens. Because this isn't just about traders anymore. China is still bidding. Not sporadically. Consistently. That tells you something. In the past, when prices rose, they stepped in to control them. This time, they're letting price move. That's a shift. Right now, securing supply matters more than suppressing cost. Physical metal is being pulled out of the system. Quietly, steadily. This isn't speculation. It's strategy. And it's happening against a fragile monetary backdrop. Silver isn't just rising against the dollar. It's rising against all fiat currencies. That's the signal. This move isn't about one weak currency. It's about a system under strain. Hard assets don't need confidence. They benefit from the absence of it. When sovereign buyers step in, downside changes. Pullbacks get shorter, floors get stronger. Because you're no longer trading sentiment, you're trading against policy. Now let's talk about pressure. Because despite everything we've covered, they're still there. Short positions haven't vanished. They've been squeezed, not erased. As long as price holds above the breakout zone, those shorts remain exposed. Every dip becomes an exit attempt. Every bounce adds fuel. This is why the market feels supported. Not because buyers are euphoric, but because sellers are trapped. That imbalance matters more than headlines. In real tops, pressure releases. Volume peaks. Everyone rushes in at once. We're not seeing that. What we're seeing is forced participation in a thin market. Structure holding. Momentum resetting. Not breaking. That's not exhaustion. That's continuation. And it sets the stage for the final move. Not the end of the story, but the direction it's headed.